Fundamental Analysis of Stocks by Charlie Munger. Charlie Munger, the longtime vice chairman of Berkshire Hathaway and partner of Warren Buffett, transformed traditional fundamental analysis by simplifying it. While most investors drown in spreadsheets and forecasts, Munger focused on understanding businesses deeply, avoiding stupidity, and letting compounding do the work. His method is not about predicting the next hot stock, but about buying a great business at a fair price and holding it for a very long time. 1. Think like a business owner, not a trader. Munger's first principle is to analyze stocks as partial ownership in a real business, not as lottery tickets. He often said that if you wouldn't be happy owning the whole business for 10 years, you shouldn't own the stock for 10 minutes. This mindset shifts analysis away from price movements and toward how the company actually makes money. Whether its customers will still exist in 10 to 20 years. How durable its competitive position is. For Munger, understanding the business comes before understanding the numbers. 2. Circle of competence. One of Munger's most important contributions to fundamental analysis is the idea of the circle of competence. This means you only invest in businesses you truly understand. You don't need to understand every industry. In fact, trying to do so is dangerous. Munger believed success comes from knowing what you understand well, what you don't understand, staying disciplined within that boundary. If you can't explain how a company makes money in simple language, you are outside your circle of competence. 3. Economic moats. The core of Munger's analysis. Munger popularized the concept of economic moats, long-term competitive advantages that protect profits from competitors. He believed that moats matter more than short-term growth. Common moats Munger looked for: brand power, Coca-Cola, Apple; network effects, Visa, MasterCard; switching costs, software, payment systems; cost advantages, Walmart, Costco; regulatory barriers, utilities, railroads. A strong moat allows a company to maintain pricing power, earn high returns on capital, survive recessions and competition. Without a moat, even fast-growing companies eventually disappoint. 4. Quality over cheapness. Early value investors focused on buying cheap stocks based on low ratios. Munger changed that thinking. His famous quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." In fundamental analysis, this means high return on invested capital, ROIC, matters more than low PE. Consistent earnings matter more than rapid but unstable growth. Durable quality beats temporary undervaluation. Munger preferred predictable compounding machines over statistically cheap stocks. 5. Management quality and incentives. Munger paid close attention to management behavior, not just resumes. Key questions he asked: are managers honest with shareholders? Do they allocate capital wisely? Are incentives aligned with long-term owners? He believed bad management could destroy even great businesses. Signs of good management include simple, transparent reporting, share buybacks at sensible prices, avoidance of unnecessary acquisitions. Munger disliked excessive stock options and empire-building CEOs. 6. Focus on fewer, better ideas. Unlike diversified fund managers, Munger believed in concentrated portfolios. He argued that the best opportunities are rare. Over-diversification is often a sign of ignorance. If you truly understand a business, you don't need 50 stocks. Berkshire Hathaway often held large positions in a few high-conviction businesses, allowing winners to drive overall returns. 7. Margin of safety, but not blindly. Munger adopted the concept of margin of safety from Benjamin Graham, but applied it differently. Instead of buying very cheap businesses with weak fundamentals, he preferred buying strong businesses with small valuation errors. The real margin of safety, according to Munger, comes from a strong moat, conservative financing, reliable cash flows. This approach reduces the risk of permanent capital loss. 8. Mental models, the hidden advantage. Munger believed traditional fundamental analysis fails because people think in one dimension. He introduced the idea of using multiple mental models from economics, psychology, engineering, and biology. Examples: incentives drive behavior. Competition destroys excess returns. Human bias leads to mispricing. By combining these models, Munger avoided common analytical traps and better understood business reality. 9. Avoiding stupidity is more important than being smart. Munger famously said, "All I want to know is where I'm going to die, so I'll never go there." In investing, this means avoid excessive debt. Avoid businesses you don't understand. Avoid hype and fashionable trends. Avoid leverage and short-term speculation. Most investors fail not because they lack intelligence, but because they ignore obvious risks. 10. Long-term holding and patience. Munger's fundamental analysis only works with long-term patience. He believed the real money is made by holding, not trading. Compounding needs time and inactivity. Frequent trading increases mistakes and taxes. Berkshire Hathaway's greatest successes came from decades-long holdings in high-quality businesses. Conclusion: the Munger way. Charlie Munger's fundamental analysis is not about complexity. It is about clarity, discipline, and wisdom. In summary, Munger's approach emphasizes understanding businesses deeply, staying within your circle of competence, favoring strong moats and quality trusting, long-term compounding, avoiding stupidity above all else. This philosophy turns investing from speculation into ownership of enduring businesses, which is why Munger's ideas continue to shape the world's most successful investors.